This is Nightly Business Report with Sue Herrera and Bill Griffin.
Tariffs and technology, those two big concerns for the market, sent the Dow plunging more than 700 points.
We have a tremendous intellectual property theft situation going on.
The president turns up the heat on China, announcing a new round of tariffs, sparking concerns of a trade war.
If we find misuse, we're going to tell people.
Facebook executive Sheryl Sandberg vows to better protect users. But is the next step regulation? Those stories and more tonight on Nightly Business Report for this Thursday, March the 22nd.
Good evening, everyone, and welcome. A sell-off on Wall Street. All 30 Dow components closed lower. About two-thirds of the stocks in that index fell more than 1% today. Half of the S&P 500 is now in correction territory. Investors became unnerved after the White House unveiled a new round of tariffs that some fear could threaten a trade war with China, the world's second largest economy. So by the close, the Dow Jones Industrial Average had plunged 724 points to 23,957, a nearly 3% decline. The Nasdaq fell 178 and the S&P 500 lost 68. The biggest losers on the Dow were the major industrials like Caterpillar, Boeing, and 3M. Bob Pisani reports tonight on that sell-off from the New York Stock Exchange.
Stocks closed right around their worst levels of the session, with the Dow down more than 700 points. That's right, 700 points. The markets are clearly concerned about two things. Number one, technology, and number two, trade. Two big issues. President Donald Trump announced he would be imposing tariffs of up to $60 billion on Chinese goods over the next several weeks. No details on which products will be taxed or by how much yet, but he did say there would be a 30-day grace period to negotiate those terms. Shares of U.S. and other metals and mining stocks got slammed on news that Trump will be exempting a handful of allies from steel and aluminum tariffs, including the European Union, South Korea, and Brazil. In fact, U.S. steel is down 20% since those tariffs were first announced a few weeks ago. Looks like they're not as tough as some people thought they might be. Facebook is facing an existential crisis right now. In fact, the whole social media group is, and that's weighing heavily on all the other social media stocks. The stock market has lost its key leadership group, technology, and social media is a part of that. And there's really nothing taking its place. The subsectors that power tech higher, which were semiconductors and the FANG names, your Facebook and your Apples and your Amazons, they've stopped advancing, and in most cases they've reversed. So once those FANG and semiconductor stocks stopped going up in the second week of March, the market stalled out because no other sector has stepped forward to lead the market higher. Industrials and materials are suffering from these trade war concerns. Banks can't move higher without the help of higher bond yields. That's not happening. On top of that, drama in Washington is still on the front burner. Stocks did fall earlier on word that John Dowd, President Trump's lead lawyers in the Russian probe, had resigned. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Mike Santoli is also at the New York Stock Exchange. He joins us tonight with some more insights on this decline. I think you were the one who coined the term tariff tantrum. Is that all we saw today, or was there more going on, do you think?
Bill, I'll take the blame or the credit for that one. Yeah, I don't think it was all we were seeing today, but I think that was the added element this morning, right at the outset, that came upon a market that also was already concerned about this general notion that interest rates are going up. This Fed is looking for opportunities to bring rates higher if they can, if the economic data allow for that. And then, as Bob was saying, the loss of leadership from the big tech group, which a lot of investors, I think, were hiding in because it seemed like they could grow in almost any environment. But the tariff issue is a reminder that policy across a bunch of fronts, whether it is trade or monetary policy, have turned a little bit less friendly than we got used to last year.
The volume, though, Mike, I mean, it didn't seem like they were just throwing stocks out the window today. Was that mostly the professionals who were selling?
Interesting. No, you're absolutely right, Sue. It was not a feeling of panic. It was not this mass liquidation of stocks. As a matter of fact, a couple of folks were pointing out that small cap stocks had outperformed the large cap indexes, so the more domestically focused businesses seemed like they were not caught up in this sell-off quite as much. The volumes weren't that high. The volatility index definitely got up there, but not at levels we saw in early February. So it was a somewhat lower intensity sell-off than we did see in early February. Whether that's something that means that that folks are more likely to buy it at this level or not is not clear, but it definitely was not indiscriminate.
Mike Santoli at the New York Stock Exchange for us tonight. Thanks, Mike.
Thank you.
So as we mentioned, the president did announce his toughest trade action to date. And as Kayla Tausche reports from Washington, there are fears of more to come.
President Trump signed an order that paves the way for steep tariffs on a wide range of Chinese imports. The move marks the end of a 7-month investigation into Chinese tactics to challenge U.S. technology dominance.
We have a tremendous intellectual property theft situation going on. So we're going to get it taken care of. And frankly, it's going to make us a much stronger, much richer nation.
The action comes as the U.S. is imposing tariffs on all imports of steel and aluminum, with certain allies and products exempted, and on top of tariffs on Chinese-made solar panels. U.S. exporters, including soybean farmers, pork producers, and aircraft maker Boeing, are bracing for a counterpunch from China, which says it will take all necessary measures to safeguard its interests. U.S. Trade Representative Robert Lighthizer told lawmakers that kind of retaliation is unfair, but doesn't change things.
It's not possible to take the position that because of soybean farmers, we're not going to stick up for our rights in a whole variety of ways and have hundreds of billions of dollars worth of other exporters and domestic producers be punished because of unfair trade.
The CEO of engine maker Cummins, Tom Linebarger, fears the administration's approach is leading to a trade war.
We agree there are challenges in China. We just want to address it a different way, a way that's proven effective over many, many decades, as opposed to unilateral tariffs, which have always proven ineffective.
But Commerce Secretary Wilbur Ross says those fears are overblown.
I think there will be some ultimate retaliation, but I don't think it's going to be the end of the earth. There may be some firing shots over the bow, but I believe at the end of the day, this will end up in a negotiated settlement.
A senior administration official tells me this is just the kickoff to a set of multiple penalties against China, and that further actions, namely restrictions on Chinese investments in the United States, could be unveiled in the coming days. For Nightly Business Report, I'm Kayla Tausche in Washington.
And joining us right now to talk more about the new tariffs and the impact they could have on the markets and the economy, joining us tonight, Art Hogan. He's Chief Market Strategist with B. Riley FBR, and Josh Feinman is Global Chief Economist at Deutsche Asset Management. Good to see you both. Art,
good to be here.
How do you step aside and let things clear out, or do you see opportunities already presenting themselves as a result of these tariffs being imposed?
That's such a good question, and I think you have to think about that 3 ways. Yes, I think we overdo the sell-offs, and today was certainly overdone. Can it get worse before it gets better? I certainly think so. I think fundamentally, this market is underpriced, and certainly more underpriced today than it was yesterday. I think the problem with this is we don't know how far our government will go with tariffs down the road to trade wars versus using this as a negotiating tactic. And it really feels like, I think Secretary Ross just said that, we hope to get a negotiated settlement. That's the best case scenario. Unfortunately, unintended consequences can creep up on us. So until something like this turns economic and actually slows the economy down, I'll give you a great example of it. NAFTA, if we walk away from those negotiations, we lose 0.5% GDP growth this year. That's something we need to make sure we accomplish. And the same thing would be true if we got into an extended trade war. That would be very bad for the economy.
Yeah, Josh, weigh in on that if you would, because you say that although a benign outcome certainly is not guaranteed, the realistic economic impact may be smaller than perhaps what Wall Street is fearing.
Yeah, I mean, you look at the move today, while I think ill-advised, it affects a very small part of the U.S. economy. You're talking about less than 0.3% of GDP. Even if you get some retaliatory measures from China, not likely to have big macro repercussions. And if this is just a negotiating gambit, okay, it'll be fine. The worry, though, is that it could escalate into something more, and also that it reflects a protectionist mindset. this view that somehow trade is a zero-sum game, trade deficits are a sign of weakness and foreign malfeasance. And I think that's a deeply misguided view, and one that ignores the tremendous benefits that have accrued from the post-World War II free trade order and the damage that could be done undermining that, and the damage that has been done in the past from protectionist forays. So that's the worry that I have.
Josh, to this point, we have not had the kind of inflation that the Fed might be hoping for, oddly enough, as they start to raise interest rates. But if we impose these tariffs down the road, that could bring the inflation back, don't you think?
It could. Depends on the scope of the tariffs and so forth. It would be likely a short-term bump up, though. What not likely to have the kind of lasting effects on inflation to get inflation back up to 2% by itself.
So if you have a long-term time horizon as an investor, you have a confluence of events that are going on. You have the tariffs going into effect. You have Facebook and social media under fire, possibly facing some regulation. What do you do? Do you put new money to work in those sectors because they've come down so much, or not?
Well, I think you asked the question the best way we should ask that question. If your time horizon is a long-term investor, a lot of this is going to be noise, and we won't be talking about it next year. Unfortunately, in the news cycle that we're in, we're going to be talking about these things on a minute-by-minute basis. So, for example, I think we will see an administration that says these trade wars or these tariffs have adversely affected the economy and the market. Remember, they like to use the market as a scorecard. And you will see a pullback from that. I think regulation is probably good for social media. I think it's the wild, wild west, and I think it needs some. I think we'll see those valuations get to a place where perhaps they're more normal towards what they're doing. And I think we'll be fine with that. But right now, there's going to be a great deal of volatility. There's more volatility this year than we have seen in any given year for the last 10 years, right? So if that makes you stay up at night, then your exposure to the market is probably a little too high, and you should think about ratcheting that down.
And quickly, Josh, if this is a headwind for the economy, does the Fed have to rethink its plan for raising interest rates later this year?
If it were a serious headwind, yes. I think based on what we've seen so far, it's likely not to turn into that. But that's the risk, and we'll just have to be watching it very carefully. When you rattle trade sabers, you run the risk of unleashing adverse economic consequences.
Josh Feinman with Deutsche Asset Management, Art Hogan with B. Riley FBR. Thank you both for joining us tonight.
Thank you.
Thank you.
In Washington, the House passed a $1.3 trillion spending bill. The 2,200-page legislation will fund the government until October. It will increase military spending and a number of domestic programs. The measure now heads to the Senate, where it is expected to pass with bipartisan support. And the president said that he will sign that bill once it reaches his desk.
Meanwhile, a key congressional committee has asked Facebook CEO Mark Zuckerberg to testify about that data scandal that improperly accessed personal information of about 50 million Facebook users. And that pressured the stock again today. It's now down more than 10% over just the past week. Julia Boorstin talked to Facebook executive Sheryl Sandberg today about the controversy and what she plans to do next.
With Facebook shares down 10% this week, Chief Operating Officer Sheryl Sandberg weighing in on the data privacy scandal that's raised concerns of users, investors, regulators, and advertisers.
This was a huge breach of trust. People come to Facebook every day and they depend upon us to protect their data. And I am so sorry that we let so many people down. We spent the last few days trying to get to the bottom of what happened. Cambridge Analytica never should have had this data. They told us they deleted it, but it is our mistake that we did not verify that. Years ago, we changed platforms so apps get much less data, but that really wasn't enough.
With advertiser Nestle today raising questions about consumer privacy, Sandberg stressed that their business model does not put consumer data at risk.
We provide a free service, and that's an ad-based business model. And in order to do that, we do not sell your data. We are able to show targeted advertising that's relevant to people. We're able to give advertisers aggregate anonymous reports, never telling them who you are. We believe that we can operate our service with our current business model, continue to provide a free service all around the world, and protect people's data, but we are going to have to earn that trust.
Sandberg saying she wished that she and CEO Mark Zuckerberg had weighed in on this controversial issue sooner. She also said that they're laying out strong steps to prevent this from ever happening again, and they're working to earn back consumers' trust. For Nightly Business Report, I'm Julia Borston in Menlo Park, California.
JP Eggers joins us now to discuss what a regulated Facebook would look like. He is a professor of management at New York University's Stern School of Business. Professor, welcome back. It's always good to have you here.
Thank you very much.
You know, one of the clips that was not in Julia's piece was the question of regulation. And Ms. Sandberg basically was open to the concept of regulation, as was Mark Zuckerberg yesterday, which surprised a lot of people. It seems to me they think it's a foregone conclusion that that is coming their way. What do you think?
Well, I think the recognition that there's obviously been this, as Ms. Sandberg said, kind of a breach of trust, and the implications that the government and policymakers may want to try and weigh in on that, and the implications of that. I think this becomes a real question. Can Facebook help to kind of co-create the regulations that might be put in place that would govern some degree of control over both advertising and the management of social media online? To me, the real question is, you know, how deep those regulations would actually go if they were to be put in place, and how enforceable they would be. There's been discussions around things like transparency in advertising, but it's unclear to me how that would actually work, who would verify that, how that would be done in any way that would be reliable. Certainly the government doesn't have the resources to go do that, and it's not in Facebook's interest to take on that responsibility.
You anticipated my question, JP, because I was going to ask what exactly you need to regulate, and Mark Zuckerberg acknowledged that it was transparency in advertising that he felt would be the target there. But it's not going to be just about Facebook. We're talking about perhaps all social media that'll be subject to these regulations, right?
Social media and just kind of online media in general. Look, I mean, Google is the biggest seller of advertising online, and if we're talking about ways to try and regulate transparency in advertising, it would certainly affect Google at least as much, if not more, than it would affect Facebook in this way. Obviously, those two big players are going to feel that kind of a disproportionate volume of any sort of regulation that gets put in place because they are the main ones who are selling ads online. But yes, I think this is the way in which Mark Zuckerberg is trying to push for this co-creation. You never want the regulators to come just after your business. You want them to be coming after the entire sector so that there's a level playing field as close as possible for all the firms.
Now, a number of these companies obviously do business globally, and different countries have different rules about how they can function in their countries. The European models are much more conservative than the U.S. regulations. Might the companies try and avoid regulation by adopting some of those European regulations or European rules?
I think certainly the risk would become that if the companies resisted this sort of regulation, that the most stringent form available might be the one that's put in place, which would definitely be bad for their business. The ability to engage in micro-targeting, even if they're not kind of selling data externally, but to help and facilitate micro-targeting for advertisers is a huge portion of what makes Facebook successful. And to the extent that there are data privacy limits that go beyond simply disclosure of how your data is used, but actual regulation of exactly how the data could and couldn't be used, that would be much more significant for Facebook's bottom line. All right.
JP Eggers, thanks so much for joining us again.
Thank you.
JP is with the New York University's Stern School of Business.
By the way, Commerce Bank and Mozilla are temporarily pulling their advertising from Facebook because of this user data controversy. Commerce Bank cited brand safety and data security, and in a blog post, browser maker Mozilla said that despite promises from Facebook executives, it takes issue with the social media company's default privacy settings. Mozilla said that when Facebook takes stronger action in how it shares customer data, it will consider returning.
It is time to take a look at some of today's upgrades and downgrades. The auto parts maker Visteon was downgraded 2 notches to underweight from overweight at Morgan Stanley. That's Wall Street's only sell rating on the stock. The firm says the Visteon could be an acquisition target, but the level of insider selling suggests a deal is unlikely in the near term. Price target was cut to $110 a share. The shares dropped 6% to $113.45. Trivago's shares were cut to underweight from neutral at JP Morgan. The analyst there says its hotel search business will remain challenged. The price target is now $8. Trivago shares fell 5% to $7.40. Bill?
JP Morgan also downgraded online car shopping service provider TrueCar to underweight from neutral. The firm is concerned about weak automotive industry trends overall, and the price target they cut down to $10 a share. The stock fell 1% to $9.80, just below that. Ralph Lauren's ratings was raised to outperform from market perform to at Cowen & Company. The analyst says that the luxury brand growth could accelerate as a result of its marketing and digital strategy. The price target was raised to $122 a share. Shares, though, were down along with the rest of the market, closing 1% lower to $107.66.
Still ahead, Nike just does it, reporting better than expected earnings, and that could set the tone for trading tomorrow.
Late today, cloud storage company Dropbox priced its IPO above expectations. According to CNBC, the highly anticipated offering priced at $21 a share. The range was anywhere between 18 and 20. Dropbox is expected to start trading tomorrow. It will be the largest tech IPO since Snap started trading more than a year ago. Sue?
Bill, the Dow component Nike reported better than expected earnings and revenue, fueled by growth in its international sales and its momentum in China. The CEO said he sees a sales slump, though, in the U.S. reversing, and that sent the stock initially higher in after-hours trading. Courtney Reagan has more on Nike's results.
Nike's strong third quarter results driven by strong international sales. Sales coming in stronger than expected in Europe, Greater China, and Asia Pacific, though Nike's North America sales disappoint. CEO Mark Parker says sales direct to consumers rather than through a retail partner like a department store grew double digits internationally, with China leading the way. It's been a difficult week for Nike after Parker sent a memo to employees revealing allegations of inappropriate workplace behavior had been reported, and two executives left in the wake of that announcement, though Nike didn't officially tie them to those allegations. For Nightly Business Report, I'm Courtney Reagan.
Chipmaker Micron beats expectations, and that's where we begin tonight's market focus. After the bell, the company said that broad-based demand for its memory and storage products led to a strong quarter. The company expects that to continue. That's why it gave guidance for the current quarter above estimates. Shares were volatile in the after hours. They finished the regular session, though, down more than 3% at $58.92. Higher selling prices helped earnings top estimates at home builder KB Home. Orders rose, and they were also stronger than expected, but investors focused on revenue, which came in light. Shares were volatile in after hours and finished the regular session down 3% at $28.84. Darden said that an increase in the number of restaurants in operation helped profits top expectations. The owner of Olive Garden and Longhorn Steakhouse said that it raised its earnings guidance for the rest of the year. Overall, sales, though, were a sore spot for this quarter. They rose less than anticipated. Darden shares off nearly 8% today to $85.94.
New product launches helped G3 Apparel grow sales and profit above street expectations. But the owner of brands like Tommy Hilfiger and Calvin Klein gave guidance for 2019 that was below street estimates. Shares of G3 plunged 12% today to $33.01. Carnival said a rise in onboard spending helped that cruise line top both sales and profit expectations. The company said demand remained strong. Carnival shares fell 1% to $66.20.
Coming up, AT&T spars with the U.S. government. At stake, $85 billion and Time Warner. We head to court next. The biggest antitrust case in a generation has finally gotten underway. The Justice Department, as you know, is suing to block AT&T's $85 billion merger with Time Warner. Hampton Pearson is at the courthouse for us tonight. Hampton?
Well, Bill, this was like really opening day of that long-awaited legal battle between the Department of Justice Antitrust and AT&T Time Warner. Opening arguments attended by, among others, AT&T CEO Randall Stephenson, as well as his Time Warner colleague Jeff Bewkes. What they heard once they were in court is the government essence saying that this merger would see consumers paying higher prices and less innovation going forward for all the video, however they choose to receive it, whether it's on a TV, smartphone, or tablet going forward. The lead government lawyer even said in court that AT&T would use Time Warner as a weapon against its competitors and to some degree against consumers in future negotiations going forward, because Time Warner is considered to be must-have content. On the flip side, AT&T says the government has it backwards. They have to get in the game because of the likes of Facebook, Netflix, Amazon, and Google that are getting more and more subscribers in their online formats and, frankly, beginning to win the war with advertisers. This trial is expected to last 6 to 8 weeks. We're just getting started.
All right, Hampton Pearson for us in Washington tonight. Thank you, Hampton. And there's more sad news from the Toys R Us world tonight. The founder of the toy retailer has passed away at the age of 94, the great Charles Lazarus. He founded the company 70 years ago. He rightly anticipated that the post-war baby boom would create demand for baby supplies and toys. Boy, was he right. He remained CEO of the company until 1994, and the man who succeeded him called Charles Lazarus the father of the toy business.
Before we go, here's another look at today's sell-off on Wall Street, and it accelerated as we went into the close. The Dow Jones Industrial Average finished down 724 points to 23,957. The Nasdaq lost 178, almost 179 points to 7,166, and the S&P lost 68 points. So, quite a day on the street.
Indeed.
That does it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. See you tomorrow.